Good afternoon and a very warm welcome to everyone. Thank you for joining us today for our monthly Regulatory Insight series. For this month, we are focusing on energy derivatives. I would like to give the floor to Shweta Ravikumar, the Executive Director of FSR Global, to make the opening remarks.
Thank you, Maheli. A very warm welcome to all our participants and speakers. Today's topic is a relatively new and exciting topic in the context of Indian power market discussions. So we're super happy to have a very nice set of speakers. We have Alejandro, who's coming in with the international, particularly the US perspective of how things have emerged on electricity derivatives in particular there. Then we have Professor Ajay Pandey, who has been leading some of these discussions, coming in from IIM Ahmedabad, who will talk about what are the implications of introducing electricity derivatives in the case of India. And then we will have reactions from the different trading platforms. We have the IEX Power Exchange represented by Mr. Rohit Bajaj. Then we have Ms. Ruchi Shukla from MCX, who's the Commodities Exchange. And then we have Mr. Rajesh Cherial from the PTC group. So we will see how the different stakeholders have to interact on a topic such as electricity derivatives, because we had the opportunity to discuss on forward markets, particularly the physical aspect of forward markets in our previous discussion. Today, we're going to tune in a little bit more on the financial side of things. So there are many simple but yet important questions that we would love for our speakers to address. Firstly, what sort of derivatives do we need to bring into the electricity power ecosystem? And would these electricity derivatives be purely financial in nature or also financial linked with physical delivery? How do we sort of understand the nuance and the differences between them? And then, of course, how will each of these derivatives be settled going forward? Particularly, how would this pricing be pegged to the spot market, and then which segment of the spot market would the pricing aspect be pegged to, and how would that again go with the settlement after we reach the delivery time? That would be another interesting aspect to see, because the way electricity is different from other commodities is that it varies throughout the day. So how do we sort of link it? And then, of course, then comes to the different types of derivatives that's available, and how do we sort of see, do we see futures more in smaller volumes and in the short term, or do we see a little more larger volumes of forward contracts, or even different innovative kind of swap contracts, such as contracts for differences? Which of these different options on the menu do we sort of foresee sort of emerging in the Indian power ecosystem? So with some of these opening questions, I would like to start inviting our speakers to present their different views. And to all the audience, if you have questions, do place them in the Q&A box. We will take it up towards the end of the discussions. And also the speakers are invited to engage with them directly also through the chat. If you already see, you can address that. So I would like to first off welcome Alejandro to take the floor and present to us on why derivatives, the what, and again by whom. Yes, the floor is all yours.
Thanks a lot. Thanks a lot, Shweta. Good afternoon. First of all, I would like to thank the French School of Regulation for the invitation to participate in this event. So let me start by the very simple questions on why we should be thinking on using derivatives. And we have to go really to the basics. And beyond going into how they should be applied to the power sector, we simply should remind that derivatives are an instrument to handle risks. And with that perspective, I think we can understand that there are many risks that are handled in the power sector that have to be mitigated. And that's what these instruments have been built in other jurisdictions. But something that is very important is these kind of risks are very specific to the power sector. And these kind of instruments, they have to be adapted to the nature of the power sector. This is something that usually it requires also a spot market to work. This is an input for these kind of instruments to work. And this is great news. India has worked very hard in building an electricity spot market. And now it seems to be a good time to start taking the advantage of many these kind of financial instruments and the opportunities that they provide. So going back to the basics, okay, what are the kind of risks that we might want to handle? So let me provide us a few examples. For instance, what happens when there is a PPA and the generator and the off-taker, they have to manage a risk. For instance, what happens when the plant is not available? Or this is something very relevant for the regulators. What happens if there is not enough capacity during super peak hours? No, this is also one of the risks that we want to handle from a social point of view. No, it's not only from the market participants' point of view, but from a whole social perspective. There is also other kind of risks that we need to handle in the power sector. For instance, a utility that has a risk that may need to buy electricity in the wholesale market, but actually it gets certain obligations, but the price that it can be transferred to the consumers it might not be able to transfer directly, no, or as fast as they would like to, no. It might be much more gradual if there is an increase in the prices. So there is a mismatch also in this kind of situations. And another risk also that we face is the utilities. They might have uncertainty on what is the demand for electricity in 1, 2, or 3 years. And in many systems, basically, it is the utility taking all of the risk of this. There is this demand risk. So there are many examples, and I have done really an effort to make clear that these are very idiosyncratic to the power sector. No, these are the kind of risks. These are the kind of questions that we are trying to figure out how to solve the problems we are trying to solve in the power sector. So there are good examples of financial instruments that have been crafted in order to fulfill the needs of the power sector. And going back in this on the examples I was setting, when I was saying, for instance, that there is a PPA and the generator and the off-taker, they have to manage the risk of what happens if the plant is not available. Well, there is an instrument which is called a call option, which is a financial instrument in the sense that there is a physical plant behind that contract, no? But the settlement is financial. And that allows the plant to handle their operations in an independent manner and to fulfill the contract buying from the electricity from the market, which brings a lot of efficiencies, by the way, and makes these kind of contracts much more, the enforcement of these contracts, it's much easier. And this is what the World Bank uses as a term. They define that instead of a PPA, a synthetic PPA, no? Which has many advantages on the efficiency side. For instance, there is other kind of instruments that have been created. No? What happens if we want to be sure that there is capacity during the super peak hours? In France, for instance, there is an instrument which provides a capacity credit, and there is a regulatory obligation for every off-taker in the system. At the end of the year, they have to show the regulator that they have enough capacity to fulfill the peak demand. And it's the generators and the demand side response resources who are awarded those credits. So there is in the power exchange in Europe, there is one product for the French capacity credits, for instance. So this is another kind of instrument that has been created. There is also in the very specific problem for a utility that doesn't know what is exactly the demand that is going to have in this year, next year, in 2 years from now. There has been created a very nice auction that I really like. This has been implemented in New Jersey, in which basically what is auctioned, the bids are for 1% of the peak demand. So the bidders often are generators who say, I'm going to fulfill 1, 2, 3% of the demand of the related retailers in New Jersey. And then what this instrument makes is that it transfers the demand risk to the generators. No, it's not the utility anymore who's going to get this. The burden is shared with generators. And that way you are sure that you are not going to be overcontracted. And the generators, they do their numbers on how they want to do this. Maybe they want to keep some old plants there in case if it is too high. They know they're going to have very cheap plants at a certain point, but they are the ones to handle the risk. So I will stop here providing this kind of examples. I would just like to have like a couple of comments. In general, these kind of financial contracts, we have to separate the fact that they are in exchange, no, they might be traded in a power exchange, from the fact that there is no physical plant behind. No, that's a completely different aspect. There can be a financial settlement of this kind of contracts. This has plenty of advantages, no, but for certain of these products, we want to make sure that there is a credible generator behind, no, for the capacity credit, for instance, no, this example for certain, and this should be reflected in the guarantees. Of course, in very sophisticated markets, there are participants that they can get fully virtual contracts, I would say, no, without an asset behind. But in this case, there are regulations that make this very expensive because you need to put a guarantee that you are able to fulfill. And these guarantees, they should be graduated depending. If you have a plant, it's not the same as if you don't have a plant, right? If you have a plant, it's much more likely that you will be able to deliver. If you don't have a plant, the risk is much larger. So the kind of guarantees that they need to be adjusted depending on who is the generator. And this is my last remark, is overall, it is very important for us to remember that these financial instruments are a tool, no? And these tools, they can be used with a public policy perspective, no? And each of the examples I have taken, there are often things that are regulators and authorities are concerned about. Now, what is the peak demand? If capacity, there's going to be enough capacity, what is the price in the long term? All these kind of things are really of our interest. So all these instruments, what is good news is that they expand the tools that policymakers have in order to achieve their policy objectives. And this is a very important question to remember. I will stop here. I would like to thank again FSR for accommodating my participation. I'm afraid I need to apologize for leaving early. I won't be able to stay for the discussion, but I'm looking forward for the recording. Thanks a lot.
Thank you so much, Alejandro, for joining us even during a crunchy day for you. So with that, if you have any questions for Alejandro, do put them in the Q&A, where we will take it up towards the end, and we'll also make sure we can answer some of it later. So moving on to the next speaker, we have Professor Ajay Pandey, who's going to go back a little bit. Alejandro already dived deep into what are the nitty-gritties when it's applied to the power sector, but let's take a step back and understand from Professor what are the implications of introducing a new tool in the Indian power market.
Well, thanks, Shweta. And I think I'll build on what Alejandro has already sort of spoken about. Essentially, the derivatives are a way in which you can manage different kind of risks. Quantity, price, availability, resource, at least whether the resources are being utilized optimally or not. You can nudge all this using derivatives. Maybe I would start off with a small PPT. I think I've already shared, if you can share with the others. So just to sort of make sure that I cover basically whatever. Yeah, so we can skip this first one. So I think moving on to the context, I think all of you who are here know, at least in Indian context, most of currently the market is structured the way it is. It's based on PPAs, which are physical in character, and of course some bit of bilateral short-term, medium-term contracts. We also have electricity markets which are offering day-ahead, intraday, real-time, and term-ahead contracts, but they account for very small part of the market for dispatch. And again, you know that at ISTS level, the India has already implemented SCED, which is Security Constrained Economic Dispatch. This uses contracted energy prices for dispatch. And the objective was to move towards market-based economic dispatch, which has not yet been implemented, but hopefully it will be implemented. So this is the context where we are. And I think Alejandro has already talked about, and I guess you must have been discussing that using physical contract. In fact, he started by saying is that what happened in case the plant is not available, having entered into a long-term. I mean, then obviously this is a physical issue. And if the plant is not available, it's not available. And if you want, the counterparty can dispute or they might be default. So the recourse will be to enforcement. And this is not something which markets like. Markets would like essentially the mechanism to be available such that the counterparties are assured of whatever they wanted without having to go through the legal side of the enforcement or any kind of dispute mechanism. The second thing is that there is a lock-in when you have these kind of bilateral contracts. And if you want to really offset, for example, if a utility buys in excess and thinks that now it doesn't require that much of power, it has to then offset by selling it to someone else or freeing the generator to sell it to someone else. Now this creates basically new set of counterparty risk exposure. So these are the issues. And then of course, in long-term contract, if there is, for example, if you fix the price, then there is a possibility of default by the counterparties. If you don't, then the price risk remains has to be hedged. So basic issue is that there are known limitations of bilateral contracts. And market is always considered a better, let's say, a mechanism for managing all the quantity and price risk as compared to long-term contracts. They have their own advantages, but they have their own issues. Now, basically, derivatives, you can think of like taking advantage of the, let's say, forward contracts or bilateral contracts, and also taking advantage of the market. And we have, I think we can create, I think, except for physical capacity, practically every other problem can be sorted out by creating suitable financial contracts in the context of energy. And it's just left to imagination as to what is the problem you're likely to encounter. And you can solve it by actually creating a purely financial contract. Some of them may require physical settlement. Some of them may require cash settlement. That's the only thing. But except for physical capacity, let me repeat, everything can be solved by creating suitable contracts. And if you're talking about market-based sector, I guess that's the ideal, that you don't require too much of intervention by either the legal side or the regulatory side. Let it be, regulators can only look at what the markets are doing, whether they are doing anything funny, which is not appropriate from the point of view of the public policy or public value, but otherwise they leave it to work based on the set of contracts which are already available for the players. That's basically the objective. We can move on to the next one. Now coming to, and you know that there are special characteristics of electricity sector itself. Electricity can't be stored in large quantities. So the prices between spot prices and the link between futures and forward or any other derivative price is not driven by cost of carry, which is what happens in case of most of the other markets. So there is also one additional advantage, if you will, that if you have the derivative markets, then particularly futures and so on, they may actually end up discovering price. So in addition to managing the risk, there's another role which the at least futures, etc., can play in the electricity sector, which is to let the price discovery take place in advance. So people are really looking at as to what kind of prices are expected based on the expected demand and supply characteristics, which can be used for hedging, but it also is a good input for the players who are active in the market as either producers or as consumers to start worrying about what they need to do in order to respond to those prices. So that's another thing. Can we move on? Now, coming to necessary condition, I think Alejandro has already talked about it. I think necessary condition would be basically that we need to have a clarity on the reference or spot market, whether we want to do physical settlement or whether we want to do cash settlement. I think we need to have clarity on what is the market which will be providing the basis for settlement. And this is currently, unfortunately, not yet reality, but we don't have, for example, single market for dispatch even at the ISTS level. I mean, the SCED is there, then the power exchanges are there, but they don't discover really exactly one's common price across all these forums. Now, so the point which I'm listed is a good beginning would be if you have a full-fledged MBED, which is at least at the ISTS level, you have a single price and it has good liquidity at that level. Then second, of course, is that derivative, whichever is introduced, should be actually fairly liquid. So that's useful for both the hedgers. And of course, you can't really have only hedgers in. If you want to create liquidity, you have to allow others to also participate. They may not do physical delivery. They may square off, or they may, if you design it as cash settle contract, then they may get the opportunity to settle that on cash basis. But whatever be the case, but the necessary condition is, of course, to have good amount of liquidity in the derivative market. So it's not important that how many contracts are being introduced, but whichever contracts are there, at least people start using it. They have the confidence that they can be used for hedging, or hedging either the price risk or the quantity risk in order to sort of to be useful to at least for the hedgers or for the end users. Okay, and if you have other speculators coming in, it will also improve the price discovery, which was the last point. I mean, one need not worry about it that financialization of some of the commodity market is viewed skeptically by saying that these are the people who are pure speculators. But one way of looking at it is, yes, they are coming in as speculator, but they are also going to track underlying factors which actually affect the market prices. And they bring it out in the open. Now, that itself has lots of value, I mean, for both the regulators and everybody else. I think we should not shy away from recognizing that. If there is this also acts as kind of informal, let's say, surveillance on the market players. Because if I'm a speculator and if I get adversely affected because of some player who has actually the market power to influence the spot market, then obviously I will point it out. And so that's very useful. Okay, moving on. And of course, there's in Indian context, there's an issue about who regulates these markets. I mean, and now we have an agreement between CERC and SEBI that this will be a joint thing. And I think it should be joint because SEBI, to its credit, has already got experience of keeping a surveillance on financial market. But it may not be familiar with the issues which are sector specific, such as economic or physical withholding, which can take place. And that requires information which is sector specific. And on this count, CERC has already got a, I think, division or setup for market surveillance. So I think that this needs to be done jointly. I think I would like to add that we need to also, if we want to really promote derivatives, we need to have clarity in terms of regulatory stance for power purchase cost. Currently, the mechanism is that whatever is bought physically by the discoms is allowed by the regulator as the price. If they were to use, for example, hedging, what will be regulatory stance is not known. So if they start using hedging, if the losses or gains on account of hedging, what will be the regulatory stance? As of now, it's not known. So you can't really expect them to participate unless that stance is known. Now, of course, the regulators also need to then develop the capability whether the discoms are speculating or hedging, which is also an open issue. But nonetheless, it has to be done if you want really the derivatives to be used by the discoms. Of course, final point which I have in this presentation is that if you really want full-fledged, all possible sort of contracts which can be created, I think eventually we have to move towards two things. The PPAs have to get rid of their physical delivery obligation. They should be treated as financial contracts for energy prices. This is point number one. And on the regulatory side, we need to get rid of long-term, medium, and short-term open access in the transmission, because then that itself acts as an impediment towards, for example, competing for dispatch. So these two factors, I think, will make the market more liquid if we go forward. So I don't know how it's going to unfold, all the things, but I think a good starting point, as I see, is MBED. Right now, the focus is on market coupling, but instead, if it moves to MBED, I guess we will, that could be a good starting. Thank you.
Thank you, Professor. That was a very comprehensive overview, touched upon all sides of the aspects. I think, I hope our trading platforms have quick reactions. So I'll give the floor first to Ruchi. So if you can react as MCX, because most likely that's where we will introduce these.
Yeah. First, thank you so much, Shweta, on behalf of FSR. And, thank you so much for inviting me on this platform and listening to and sharing the views with the likes of Professor Pandey and Alexandro is really great. Thank you, Shweta, once again. I'll just share a PPT and give a quick view on that. So basically, first of all, like the need for electricity derivatives in India, and as the earlier speakers, both the speakers have really highlighted, probably now is the time. The spot markets have really developed, and the short-term market is growing at a CAGR of around 14%. The prerequisites for any country to bring in the derivatives in any commodity. And plus, there is the share of exchanges. The spot exchanges are well developed. They started off around 2003, and now if we see the share is gradually increasing of the spot exchanges in the overall market, and specifically in terms of the short-term market, it has gone as high as around 53%. Then the next point is basically the shift from long-term PPAs. So as we have gradually been observing over last 3 years, and the government is also, regulatory norms are also pushing towards, we are moving away from the practice of 25 years PPAs to basically 12 to 15 years, and gradually the movement will come wherein we really shift to a more shorter tenure PPAs. And the increase in the number of participants across the value chain, if we see, yes, the consumer leg is one side, yes, but the GenCos and the DISCOM. So on the generating sides, we are seeing a lot of more renewable players. And as we move towards net zero and the recent budget, we have seen a lot of investment being proposed in setting up on the renewable side. So a lot of value chain increase is also happening on the GenCo side of it. So with this, definitely the Indian markets, it's a right time probably for the Indian markets to bring in a financial instrument from the point of view of risk management. So that's the need of the hour, though the physical side, yes, the delivery is happening through the PPAs and the spot exchanges, but there's no financial instrument either on the OTC or the exchange like right now. And secondly, if we see what drives, why do we need risk management? So when the volatility in any commodity, this goes for any kind of a commodity, when the volatility in that commodity is very high, it raises the needs for derivatives. And if we see, these are the numbers based on the short spot exchange. So if we see an average, the average daily volatility, it's been an increase year-on-year basis. And to have a volatile product as high as wherein average daily is around 15% plus, it really calls for the need for risk management. Now, in Indian context, we can also draw out some global overview, how the culmination of the spot and the derivatives have actually helped both the legs of it. So one side is the derivatives have helped the value chain to manage the risk. And on the other side, we have seen different kind of products, new products have been introduced in the spot markets also, depending on the need. So they both complement each other in the development purpose. That's like European exchange, so EEX is definitely the largest exchange in that area. And if we see the growth, now they have German power futures, French, Italian. So if we see the percentage, in percentage terms, the growth of participation in derivatives, which itself proves how these markets are growing. And on the other hand, the spot exchanges have introduced, these are developed markets definitely, but they've introduced as far as locational spread products also recently. So that's the kind of development how derivatives and spot, that's why I'm basically pointing it out, because as all the other dignitaries present here will really understand where the regulators are also, why this is getting delayed, the regulatory approvals for the electricity derivatives. This one perspective is also, while will it impact the spot markets in a negative sense? But the global perspective, if we take, no, it actually the spot and the derivatives complement each other, both the markets, and being in a commodity derivatives exchange where we have all other products also trading. So we have seen in other products also where the spot markets have really developed well based on the derivatives. And derivatives, obviously, Ajay Pandey ji really pointed out price signals. Derivative markets provide the price signals which are useful not only for the consumer side of it, but for the generation capacities and understanding how much capacity growth is really needed and what will be the right price at that point in time. So price discovery mechanism plus the risk management are the two needs of the hour for the Indian participants. And so this is of the Europe. And if we see the recent, the Japanese power exchange, which TOCOM, actually, it was the power contracts were launched in 2019. Earlier, they used to be on EX, where this is really highlighting the kind of participation we are seeing. So in Japanese market, within a span of 3 to 5 years itself, if we see, of the top 40 corporates, Japanese electricity corporations, 19 are participating on the platform itself, on the derivatives platform. So, and besides others, the count is increasing on year basis. With the launch in 2019, starting off with just 13 participants, they've gone as high as 143. So it involves all the, even the foreign power traders have come onto their platforms. And we have seen the MD CEOs of these EX as well as TOCOM actually coming out and giving statements like their platforms are used more effectively by the hedgers on year basis. This is one, just a site and touch base on an example for Gencos. If you see, these are the leading Gencos in the power sector and in the European markets. And if we see, these are all the utility companies which are hedging. In fact, they have hedged for the future. So I'm talking in terms of 2024 to 2026 still, how much percentage they are actually hedged, which has helped them, since they are the generator side, this has helped them to lock in prices in a range of euro 45 to 150, depending on the seasonal patterns and the different seasons, while the historical average ranges between 20 to 50. And definitely this also helps them to filter into how much renewable or non-renewable and how much capacity they need to develop accordingly. So that's the help. If you just one of these points, if we see the below graph, the lines are indicating the hedged prices logged in, whereas the circles are indicating the average achieved prices. So just see the variation. So they are able to get a better price also, because this is from the Genco's point of view. From the average history, they are able to achieve a better price. Obviously, when they're achieving in, suppose 2026, I foresee a better opportunity. My investment flow in building the capacity also increases. And we have seen Europe in the war times, how because of the lack of their own capacity, the prices really went, they were bizarre prices of the power sector, of the power, electricity in the European markets. Sorry. So beside, this was just a context to set in how the need has arises. And if I touch base, there have been certain questions on the regulatory front. Yes, post the Supreme Court verdict, a joint working group has been formed between SEBI and CERC. They have been jointly working on it. They have been conducting meetings to understand how they can better bring out the electricity derivative products in the market. And since we already have a spot market which is providing delivery. What is being proposed for Indian markets is a cash settled, a financially settled contract, basically for risk management purpose to start off with. And from the participation side, Professor Pandey has already highlighted any derivative market to create liquidity will need all sorts of players. So besides value chain participants, we will definitely have financial institutions or financial investors also, because one is going to build in the liquidity, one is going to suck out the lift. So that goes, one is taking the risk, one is giving you the risk. So that goes without saying, the regulators will definitely look into this aspect and bring out the best product which is suitable for the market. And at MCX level also, we have been engaging with the value chain across, be it Gencos or Discoms or the trading licensees as well as end consumers. The need from the market is definitely there. The market itself is feeling the need to have a risk management instrument, because take up any other, like Forex. I'll just cite an example of foreign exchange. USD INR is a main thing. Even if we see the average daily volatility over last 10 years, it won't be anywhere more than 4 to 5%. That's a very high range. But still, we do hedge that. But herein we are talking about a volatility of 15% basis, and we do not have any instrument in the country. One, we do not have any instrument within a country to manage the risk, any financial instrument. Secondly, electricity is a very, very nationalized commodity. So even if anybody wants, like other commodities like crude oil or natural gas or other products, bullion, you can go abroad and hedge on the other exchanges or OTC markets. But for electricity, besides PPAs, there is nothing else where you can really hedge, because you can't hedge these products abroad in other exchanges. So the need for the market is set, and I'm sure regulatory on a positive side, they are working towards it. But probably if the approval processes and all can be set in and the product can be brought in at the earliest possible for the market, it will be a huge help for the market. Thank you.
Thank you so much, Pruchi, for giving us a little bit of insight into how other derivative markets have been emerging. Now, probably I'll invite Mr. Rajesh to give us a little bit more peek into how, from the Indian side, the different stakeholders, be it utilities or Gencos, how will it sort of impact them, and what are some of the measures that they can take should electricity derivatives be introduced?
Thank you, Shweta. So I represent PTC. We are market makers, we are traders. So we occupy a unique perch in the sense that we procure power from the sellers and then sell it to buyers. So we have both perspectives. But derivatives is a unique concept, as the other speakers also said. I can also express views in the market. If everybody is going for risk hedging, somebody has got to provide liquidity, and that is the speculator. And there is also the role for a market maker there. Now, to put the context right in the Indian context, people talk about reference prices, and I heard Professor Pandey also talk about MBED versus market coupling. I have a slightly different view there. Today, we have 86% of our contracts under long-term PPAs. So those are contracts which are essentially forward contracts, 25 to 35-year contracts where the volume and the price is currently locked in. So they are essentially long-term forward contracts. So somebody who is a participant there, if they want to express a view in the short-term market, as prices fluctuate, there is a unique behavior of market participants that we have observed, that if in the interim there is a geopolitical tension and prices in the spot market fluctuate, they want to renege on these contracts and then sell it in the spot market to make a killing. Now, if there was a derivative segment in place, you can express that view without getting out of the contract. Is actually a huge benefit there. Second, if MBD has to be implemented, that means a single market. I can't have 3 exchanges with 3 different segments, all of them bifurcated into DAM, RTM, GDAM, HP DAM, multiple segments, multiple reference prices. If I want to implement something like an MBD, let it be a single market. We also saw a slide on volatility in the prices and the DAM prices. Let me be very clear. There is not a single DAM MCP price. When we say a DAM price, that is a price of 96 time blocks. And if you were to trifurcate the volatility even into segments like solar hours, non-solar hours, night hours, you will find the volatility all over the place. So in fact, it makes an ideal, if it was a financial market, I would say somebody should be trading vols instead of prices and volumes. But that's not the point. The point is that the volatility is so all over the place, just in terms of the hours in which these prices flow. So if you ask from a trader's perspective, do we want an electricity derivatives market today? Yes. Unequivocally, I would say that yes. But we are only 100 terawatt hours in terms of exchange traded volumes. You saw the slides that Ruchi showed, I think 5,600, 8,000. We are nowhere there in terms of liquidity. And if you even observe the amount of liquidity that in the spot, the so-called spot market, which are again day-ahead markets, they are not technically spot when I talk about DAM. Even there, 5 or 6 market participants influence the prices. So if that is the amount of liquidity that is there in the markets, then of course the concern of the regulators is fair and warranted in terms of market participants taking positions in both financial and spot markets to play the two markets together. Yes, we need derivatives. We need checks and balances. From a market maker's perspective, we definitely see a lot of value. We think there is a room for proprietary traders, including market makers like us. We provide the other side of the hedge. It provides an avenue for people to express short-term views, even if they are locked in long-term contracts. And I think the time is now opportune for the market to launch electricity derivatives, risk notwithstanding.
Thank you, Mr. Rajesh. You did bring in a little bit of the risk hedging versus speculation, why different positions are needed, and of course made it very clear in support of some of what was already flagged by the other speakers. Before we get in a little bit more Q&A, let me bring in our last speaker, Mr. Rohit Bajaj from the IEX perspective as a power exchange platform. We have been discussing a lot about the spot market reference, so probably you could throw some light as to how you see this playing out in the Indian context, and also what sort of products within derivatives do you see emerging first?
Yeah, thank you, Shweta. Thank you, FSR, for giving me this opportunity. I'm audible. Thank you. It is always a pleasure to be part of these discussions. And today one is a really special one because this is something which we have been dealing for a long, long time. We have been discussing this for so many years. Earlier, there was regulatory uncertainty, which has been clarified now. We have covered lots of ground, and still we do not see light at the end of the tunnel because we don't know when this would be become a reality. So I just want to mention 3 points. First is, let us evaluate where we are in terms of prerequisites which are required for launch of electricity derivative. So ideally, we should have basic infrastructure. Here, infrastructure means there should be energy market should be there in place. We should have transmission framework or transmission infrastructure should be there in place, which we already have. There are concerns raised by some of the participants that market is not as liquid as we want it to be for the purpose of launching electricity derivative, but we have that spot market available. It has been working for almost 15 years now, and we have seen a growing trend there. Second thing is we should have regulatory framework for delivery market. We do have for derivatives. It can be evolved. It is also not a, I would say, big deterrent. We can always create that. We should have diverse participant base. Here we have some concerns. When we say diverse participant base, then we talk about generators, we talk about utilities, we talk about open access consumer who should ideally be participating in the market. But last 4 or 5 years, what we have seen is there has been a major declining trend. Today, we have more than 7,000 participants registered with us, but on a given day, last 2 years particularly, the participation has reduced drastically because it is not making, many open access consumers are not participating because it is not viable for them. So what we have seen over the last 2 years is because of increased demand, the deficit situation has emerged and prices are going up like anything. In the peak hours, it is constantly hitting the cap price. Ruchi has shared with us last 2 years, the volatility overall has increased. So these are certain things which are not good for a large participant base who are basically consumers who are coming to the market to take advantage of the market which is available. So unless we promote open access or unless we have good regulation, fair play regulations available for open access, I think we have to really think about how successful derivatives are going to be, because in the derivative, as we all know, it is used by the participants to to hedge their risk. Now, who are the affected parties here? Now, if I talk about buy side, there could be distribution company and there could be consumers. Distribution company, as we know, is their buy is only 5% coming in the market. 95% they are already hedged. And Mr. Pandey made a very valid point that today regulatory framework or provisions are not there where these distribution company can participate in the market as a hedging instrument and then get it passed through, or they can there could be gain or loss or whatever will happen. That how that will be seen by the regulator, we don't know as yet. Now, the second thing what we are seeing here is for consumers, since full open access is not there in the country today, there are not many consumers who have untied up capacity. So they have natural hedge available. Those who are participating in exchange, they already have contract demand from the distribution company. When the prices are going up, they are moving away from the market and then taking same power from their own suppliers. So now we have to see from the buyer point of view, who is the real buyer who is going to come here. There is a need, no doubt about it. Today, electricity is contributing to 50-60% also in certain cases. If we talk about metal, there are so many electricity intensive units where consumption is so high, their input cost coming from electricity is very, very high. They need some ways and means how they can reduce it, how they can hedge it, how they can protect it in years to come. So since there is a natural hedge available for open access consumer, there is no provision available for regulatory for state utility to pass it on. I think we have to work on those areas so that when we are in a position to launch it, we should have some liquidity coming from the real hedgers. Speculators will definitely come. They are the market maker. We know that. And in fact, if we see global European data particularly, there is a very strong proportion which is speculator. Almost 8-9 times of the real hedgers volume comes from the speculators only. So we need that 10%, 20% real hedgers, those who are going to be participate, and we have to work on it because there is no real case available now who is going to be the participant there. We do have certain companies like some big steel plants where they have open capacities, where they participate regularly in the market, where they are risk prone, where they are taking hit on the prices whenever these prices are high, but this number is very, very limited. So open access is one key thing which we have to do. Third is transparent price mechanism, discovery of prices, which is there. And fourth important thing is lot of data requirement. So when we expect hedgers to come, when we expect people to take position in the market, we also have to feed lot of data on the basis of which they can take that position. So that is another area where we have to work. If you ask me what is the present demand, what is the demand recorded in the last time block in the country, we do not have that number available with us. So unless we make all this data available on real-time basis, I think it is going to be very difficult for anybody to come and participate in the market. Coming to the point where Mr. Pandey also mentioned that we need deep market, probably that could be MBED, where there is a lot of depth in the market. And if you increase the depth of the market, then possibly there would be less volatility. Today, when we say that the November month price was 399, suddenly in the month of December, this increased to 5 rupees 50 paisa. It is because the market size is very small. Sudden surge in demand, little bit surge in demand, we see prices going up. Suddenly there is some correction in demand because of weather event. You see prices correcting in a very big way. So I think if you have depth in the market, this will be taken care. The MBD could be one thing, or there could be many other things like government has vision of increasing the depth of the market to 25%. Presently, it is only 5%. Tomorrow, probably we can route renewable energy through this market through CFD mechanism, which will also increase the depth of the market in a great way, which has potential to increase the depth of the market in a great way. I think we have to work on those things. Presently, also there is a liquid market available. We can use this market for the purpose of launch of derivative, but a lot of work is required to be done so that wherever we are seeing gaps, we should be able to fulfill this gap. Coming to the last point, which is requirement of single price. So I don't think there is any requirement of single price if we talk about derivatives. See, by definition of derivative, it takes reference of underlying asset. Now, underlying asset can be IEX day-ahead market price. It can be IEX RTM price or PXIL X price or Y price. It can be anything. So when we talk about other market, global market, trade happens in so many different markets, and derivatives are settled on one index, which is most liquid. So it is the most liquid index or most liquid market, which the reference has always been taken in the past. And I think that this system can continue in electricity also. And I really do not see any reason for having a single price. One more thing I would add here is, in case of electricity, the price is discovered in different time frames. In long term, there is a price for 25 years. We know that there are so many, all the PPAs, they have a price. For medium term, in 3-year PPA, there is a price. Then we have short-term bilateral contract, 4, 5, 6, 7 months, where you have a price. Then day-ahead market has a price, RTM has a price, SCED has a price, and even DSM has a price. So there are so many prices which are coming and getting converged just before the real time block. When that time blocks come where supply is happening, it is converging into a one price. So when you already have hundreds and hundreds of prices available, just having one single price in day-ahead market is not going to make any difference. Derivatives can survive on multiple prices, and numerous examples are available world over where this is being done. That's it. I think I have covered all the points. Thank you.
So much, Mr. Bajaj. It was, we went into some of the other questions that I intended to open up, but we already see a lot of questions from the audience, and we are running quite short on time. So if, with the permission of the speakers, we'll try and extend it for a little 5 more minutes, also if it's okay with the audience. So I think we have one of the questions from the audience, which is not yet addressed, but Mr. Pandey and Mr. Rajesh did touch upon it, is on transmission congestion. As of today, we don't yet see it, but as volumes and depth increases, we will see. And so in that context, in the derivative markets, beside hedging for price, are we also looking at derivatives for transmission congestion? Any of you can react. You can.
See, one is, I think Rohit was saying. See, transmission, we are talking about installing 500 gigawatt by 2030. That's our target. Before transmission congestion, a 10% variation in RE is like a 50 gigawatt impact on the system. So that variability, when we say in terms of RE, it is transmission congestion is the second aspect for me. We have today implemented GNA, which says that this entire country is one copper plate and you can draw from anywhere. That's a confident regulation. So for us, and we have this CA electricity plan to build transmission corridor, green corridors and everything. We will get there sooner, later. I don't know the timelines. But for me, the bigger issue is in terms of the transmission variability that exists at any given point in time. And which today also many generators face in terms of being asked to back down when there is a peak wind capacity that is being hit. So the financial markets, and I think a lot of these concepts that we are doing and discussing, even in today's session, is a sort of hybridized concept. It's not pure. We are talking about pure financially settled derivative contracts in the Indian context. So if I had to hedge against that kind of a risk, when there is a transmission variability, I'm actually addressing my exposure, not just price, but price and volume put together. So that's the thing that we want to hedge through the financial derivatives contract, not just price or not just volume. And the single point being, see, I again want to reiterate this point. The comparison with external markets and Indian markets doesn't work. Our markets are very, very different. Our one state might be as big as an European Union. But in terms of the volume that gets traded in terms of derivatives abroad and in India here is radically different. Because as I said, even what we call as a spot market, they trade only 100 terawatt hours. That's nothing compared to what is traded above. I think closest that you would get would be the Australian exchange. I think 300, 400 terawatt hours. Even there, the size is much, much bigger than ours. So at least 3 or 4 times. So we need, when we launch a derivative contracts, because when we say derivative, it is to represent the market. If 5% of the spot market is the base price for a derivative contract, so, and if we are saying that people are going to hedge it or express the views on the market, that's a very, very narrow point of view. So if we have to look at it, we need some kind of a hybrid index if we have to launch a derivative contract. because exchanges don't just do the collective segment. They also do a bilateral segment, the term and market segment, which is growing in prominence. Actually, if, for example, if you look at the last 2-3 days, if you are doing 170, 180 odd MUs on the DAM market, you are doing 90 odd MUs in the TAM market. So it's not a small market by any sense. So when we say index, there are a lot of mechanics that is involved in terms of launching a derivatives contract. And if you look at what the past speakers said, they are all about futures. So to your limited point about transmission constraint, my thing is that what we should be hedging is exposures, the price and the volume put together in terms of an exposure, and transmission variability as big a concern as transmission congestion. Sorry, Rohit, I cut you short, please.
No. You have already answered it. So just one point I will say. So here what we can do is, to begin with, it is going to be a national contract. So we are not taking into consideration what sort of transmission congestion between the different regions would be there. So that is long way down there. We probably will reach there in few decades, because if you are going up to that level, for each of that region, you have to generate ample liquidity. And it is impossible. You cannot see it happening at this point in time. Let us start with national contracts. And as we progress, then we will identify that probably there is one contract which is required for W1 region, and then the transmission element will also come into play.
Maybe I'll add, coming from the other side, which is that maybe the question is motivated by what is the reason why, for example, I mean, Rajesh had already pointed out that the regulators suspect that 8-9 players can affect the DAM prices, no? And if the objective is to increase the depth in the reference prices, whatever that market might be, DAM, whatever, if that is the objective, there this question might be relevant. I mean, in the sense that if you have less transmission congestion, you have more depth in that market, whichever market you're talking about, DAM or whatever. So from that perspective, yes, it's important to alleviate regulators' concern, though I think as Rajesh and Rahul pointed out, it doesn't really need to be worried about so much from the point of view of launching derivatives. So it depends upon where the question is coming from. If the question is coming from regulatory side, yes. But I think on that, I would stretch. I think if the regulators don't have confidence in DAM, I guess it's partly their own doing. In other words, if they want to increase the depth, you have to move quickly to MBED. You get the depth. You get rid of short-term, medium-term, long-term open access. You get more depth. So if you really are concerned about it, you will see much less volatility in the DAM market in case all these dispatches are happening with all these restrictions gone. So I think it's partly they have to realize that they are looking at the wrong problem to start with. If they really want to sort it, they can sort it.
Thank you. Thank you so much for that quick reaction on the topics. I'm going to club two questions so that we can, any of you can again react. We have one question on how does cap on the spot markets that we see affect the derivatives market. I think we have also had this discussion, the forward markets. Most of us, we do have a ceiling. So how do we really sort of break open that? And also another linked question with that is, how does all of this link with the resource adequacy exercise that we have started to do? And yeah, after that, I will give you the last question.
I can take that. So basically, price cap on the spot exchanges was again what we see was because of, as highly pointed out, regulators seeing a few players trying to manipulate the prices. The price lock has come in, but on one side, like this may be taken as a personal view, not as an exchange view, but on one side where we're talking to bring in more liquidity in any market. And we ourselves, based on the DAM, DAM by itself has been a spot market, not very highly liquid, with 5-6% of it. And we are trying to split in the liquidity, creating two price caps in it. So that is one concern wherein regulator, yes, has brought in that price cap. In one context, this is a little hindrance to the derivatives development of, because derivatives by itself is also a price discovery mechanism for the future markets. But on the other hand, since in Indian context, it has already come in, maybe down the line, while the regulators really realize why the need has really come in, it should not be a showstopper for launching of the derivatives. Because unless and until we really bring that product to the market, the nuances will develop over a time. There will be different kind of products which will develop over time. Even like European markets lately have introduced locational spreads kind of a thing. So different kind of products, but while we are not giving the participants any product and creating every little hurdle, creating it to be a showstopper for the launch of it, it really doesn't help to develop the market itself. India being a third largest producer, consumer, electricity we are, and we are moving forward towards looking forward to a $1 trillion economy. Such a lot of consumption is coming in. We are not trying to bring in a basic product. So where it can help is, as Professor Rajay Pandey also pointed, setting up a right surveillance mechanisms. This is from the experience of commodity derivatives in other commodities besides electricity. Setting up the right surveillance mechanisms from the regulatory point of view, and the checks and balances will really help to develop, but not thinking that every little thing, every new regulation coming in the spot becomes a showstopper for launching the derivatives. That will not go a long way in developing these markets.
My quick reaction on resource adequacy, I think to the extent you have liquidated futures, it will help a little bit, but not beyond a point. As I said, I think resource adequacy is about having physical capacity, and that needs to be worried about separately. And I don't think it, in fact, it should be looked at in more integrated manner than one currently is being looked at. I mean, that's my view, of course. I think further extending Ruchi's argument is, again, price gap, the way to look at it is that 95% is non-responsive to any demand or supply variation. Only 5% is supposed to do the adjustment, which is what you're talking about spot market. So obviously it'll be much more volatile, and therefore you get upset about looking at that number when it kind of shoots us at a certain level. You would not see that number in case the 100% was responding to the changes in the demand and supply. Then this problem would automatically go away. I mean, so again, it's a problem which is like self-created problem, and I think it has to be sorted out by recognizing that it's a self-created problem.
A lot of points here are focused also on regulatory governance mechanisms and the process itself. So that's a total different debate to have one day, probably. And agree with you, Professor. Capacity is a discussion for another topic as well. We probably will try and have a discussion on capacity markets sometime soon. But two quick questions from the DISCOM perspective. Is there any thumb rule on how much of the utilities portfolio can ideally be hedged? Of course, for Indian context, we don't have yet, but internationally, what's the norm, if at all? And then what would be the typical cost of hedging as a percentage of the actual cost of electricity from international experiences, be it in Europe or Japan? I think, Ruchi, this is coming from your slides.
Yes. So firstly, taking on how much percentage of utilities should hedge, I really don't have that kind of data availability in like what percentage even for the globally. But yes, as far as we have been connecting and reading through, utilities in European markets do hedge on the platform, but what percentages, and we really don't know from the global side of it. On the other hand, the cost of hedging, electricity in exact electricity terms I may not, but the cost of hedging any products in the derivative markets is not very high. I'll just cite an example to it, because if we take a term insurance for us, so hedging from the point of view of considering it as a cost to the business is not a right criteria or a right cultural aspect, because if you take a term insurance, the premium you are paying is for the your life, okay, but that's how hedging should be considered as a sustainability mechanism. If you really want to survive with the growing input costs on day-to-day basis, then you have to be competitive in the market, and that is a cost. One side is this. Secondly, cost of hedging overall basis in other products, it's a leverage. Derivative is a very leveraged product. Besides impacting your margining mechanisms, margins and initial margins anyways are there in DAM market, also on the spot. Similar kind of margins are in the derivative markets also. but they also have cost-effective products like options. So futures and options, combination of hedging strategies have really worked. But in terms of exactly, say, if the price of cost in the DAM market is 5.5 or something, and how much will be the cost of hedging, exact numbers are difficult to come out with.
Can I sort of add on this? See, the right way of looking at this is that if you're a regulator, you would be asking this question whether the utility is hedging or speculating. Okay. And basically, what you would like to do is to check whether they are hedged overall exposure, whatever, through different exposures, net exposure, whether it is in sync with their forecast. In other words, what is the forecasting error which you are willing to tolerate? If the forecasting error is too much, then you obviously either they're doing a poor job of forecasting or they are speculating. You can't differentiate between the two. So you have to really keep this under control, that you allow certain range of forecasting error, but not any. For example, you can't say that I assume that my demand will be X and now it turned out to be 50% of X. So the remaining I had hedged, assuming that the demand will be double than what it actually turned out to be, then of course the regulator should point the object to that kind. So that's the way I think you look at it.
Thank you, Professor. Maybe just to answer to the audience who had asked this question as well. Europe, after the price crisis in the last couple of years, did bring in CFDs and in fact compulsory price guarantees that need to be bought in from derivatives. I'm not sure of the exact percentage, but a large chunk, almost 80% of the customer bases should have guaranteed prices. That's sort of the norm that they were discussing. Of course, because of abnormal prices that they experienced, they had to go to these discussions. But in India, we're still far from there, but already good to sort of discuss.
Yeah, but Shweta, I think keep that in mind there. It's a competitive market. Here, it's DISCOM is regulated business.
Exactly. Correct. So I think there's so many more nuances I would love to get into, but we're running very short of time. We didn't get much time to discuss on the different kinds of derivative products itself that could come, futures and options and swaps. And I think also discuss the famous contract for differences that we see, at least in European cases. I know Mr. Rajesh is smiling, so hopefully we'll come back to it in another discussion. So I would like to now invite Mr. R.P. Singh to make the closing remarks and conclusions, and thank you for that.
Thank you, Sudha. Can you hear me? Okay. Before I give my closing remark, I'd like to comment on some of the statements which have been made here. You know, the power sector in our country has to be not only seen from the market perspective, but it has to be seen from various other perspectives, not only legal, but regulatory, but financial, as well as, technical. So what we are talking here is in a part of compartment. We are talking mainly related to the market dynamics of it. But the prime motion of the whole power sector and the regulatory framework comes from the legal perspective. And the legal perspective, when I'm talking about the Electricity Act, becomes the key document. And in the Electricity Act, we have got two sections. One is Section 62, which deals with the regulation, and Section 63, which deals with the market. The market, anything which is discovered in market, the regulator has to accept it. It is discovered price, and the regulator cannot interfere in it. And what is under Section 62, which is regulated, the regulator decides that only. So the regulator has got very limited domain on the market discovered price. That is number one, what we have been talking here. So and someone was mentioning that how you allow the hedging of power purchase, etc. I think you were asking this question. The concept is, it is not the price variation or the quantity variation. There is a system of FPPAC, that is fuel and power purchase cost adjustment. Every DISCOM gives its annual tariff requirement, in which the quantity is given month-wise, that this month this much power will be required, and how and what is going to be the source from where it is going to be procured, and what is going to be the cost of it. And each and everything is predetermined. That means the generators, their cost of generation is known, the merit order dispatch is worked out on that, and say 5 or 10% is left, which is procured from the market. And market price, whatever comes, the regulator allows it. It does not examines the speculative part of it or otherwise, and it goes as FPPC. That is I must clarify, because I think since I've been involved in dealing in these intricacies, that's why I can share it. So anything which it procures from the exchange is allowed in its tariff plan as cost passed through. And if tomorrow or day after, in some days, say when the derivatives are introduced, the regulations may be framed out. Normally, what we do is that there are two aspects of the tariff. One is the controllable and other is uncontrollable. So uncontrollable is always allowed as a pass-through. And if it is controllable, then there is a sharing of it, that a part of it is shared with the beneficiary. So this is how the regulatory aspect is dealt with. And why I was talking about the legal aspect, because the Supreme Court has clearly said in its 2023 order, December 2022 order, that you cannot have only one route till such time there is provision in the Act. It is up to the DISCOMs or the entity to decide what route they are going to take, whether they are going to take the regulated route or whether they are going to take the market route. So MBD or SCED, they only operate to a limited exchange, and it is legally very difficult to have a retrospective impact on the legislative framework through a prospective executive order of MBED. So we have to think, obviously people are moving forward because the central government wants it and everyone wants it. But till such time the Act itself provides for that shift, perhaps it will be carrying too much of legal risk in that. Now, let me come back to my main job of closing this. And thank you all for such a nice and wonderful discussion today. And as we draw near this conclusion of this insightful webinar related to necessity of electricity market derivative, we find that it is very interesting and necessary to have derivatives trading, speculating, and hedging, which are the inherent component of the derivative market, to be taking place. While speculation involves taking position based on market expectations, hedging aims to mitigate risk associated with the price fluctuation. Balancing these components is crucial for market stability and risk management. Our esteemed speakers have shed light on the role of electricity derivative as a risk management tools amidst the volatility inherent in the emerging electricity market. Mr. Alessandro, his views on the global perspective, Mr. Pandey's profound insight from the academia, Madam Ruchi Shukla's perspective from the commodity exchange, and Mr. Rohit Bajaj's exposition on derivative from the power exchange and point of view, and Mr. Rajiv Cherial. I could hear my thoughts coming out of him. I really appreciate having heard them and enriching our understanding on this subject. The discourse has underscored the pressing need for hedging instrument to mitigate price risk exposure for the market across the value chain. And it has also highlighted the challenges and measures the requisite for the seamless implementation within Indian energy ecosystem. Our attention has also been drawn towards the regulatory landscape and the likely role of regulatory bodies like SEBI and CERC in governing the delivery and settlement of these contracts. As we contemplate the key takeaways from today's deliberation, let us not only recognize the imperative for energy derivatives, but also embrace the collaborative efforts required. I conclude by extending my heartfelt gratitude to our distinguished speakers for their invaluable contribution. Thank you very much.
Thank you,
Thank you, sir.
Archit, sir.
Thank you.
Thank you all the speakers. Thank you all the participants for an extended session. Up until next time.